Stephen Thomas with Reports on Housing, and we have another housing debrief. However, I first wanted to bring on a special guest. This special guest is Yanni. He is from visiting from Greece. He's like family to us. So, Yanni, what grade are you in?
Sixth.
Sixth grade. So I have a real, and you go to an American school, right? So that you know your
Yes.
English and all that stuff. So he knows two languages. I know like one and a half. But anyway, I wanted to ask you about the United States housing market. What do you think about the U.S. housing market?
It's all
It's okay. What about the housing market?
it's all about supply and demand.
Oh my gosh, he nailed it. Nailed it. All about supply and demand. That's right. He's got it. You know what? They come all the way from Greece, and even they know about the supply and demand of the United States housing market. Right on. Thank you. Appreciate it. Now go enjoy lunch. Cute kid. So much fun. They went to Disneyland yesterday, so he slept in like a teenager this morning. So I'm housing debrief. I'm going to invite everybody. If you like the video, to please like and subscribe to like the video, subscribe to our channel. It's just so we can get this information out to as many people as possible, so they can make educated adult decisions based upon real hardcore facts and data and stats. Not a narrative. We're not trying to push a narrative. We're kind of telling everybody what's going on right now and what to expect in the future based upon everything that we're seeing. And I have a quantitative economics and decision sciences background, and this is all that we do. We're a housing we're housing analysts at Reports on Housing. Now, this week we're going to talk about crash in sales, and it's not in prices. And what happened? Well, we need to talk about interest rates, because we were enjoying low rates for such a long period of time, especially during the COVID years. Across the United States, everybody was enjoying this very, very low interest rate environment. But then suddenly that changed. The Fed came out, and they came out swinging last year, especially about August of last year is when their tone got a little bit more harsh. They talked about all the pain that they were going to cause everybody, consumers as well as companies, and that was all so that they could reel in inflation, which, by the way, I look at all the inflation charts. It looks fine to me. I'm an economist. I know that it's been out of bounds, but what I mean by it looks fine to me is if you look at the chart, it's gone up and it's coming down. Economics is slow and boring, and it's doing what it's supposed to do. They are succeeding at what they're supposed to do. It will continue to come down. It's baked kind of in the numbers going forward. Can we get a surprise from month to month? Well, absolutely, we can. However, the overall trend is what we're looking at. The trend is your friend. But to reel in inflation, the interest rates have just gone out of control. They've just gone from 3.25%. They were actually in the twos back in 2021. Started 2022 with 3.25% interest rates, and you can see what's happened over time. Interest rates have gone from 3.25 all the way up to 8%. They exceeded 8%, but within the last couple days, yesterday and today, the Fed, not only did they meet this week, but then they had their announcement. They didn't change rates, and they're still hawkish, but they're a little less hawkish, which means that they're starting to reel in some of their comments because they've seen interest rates go really high, as well as bonds go really high, and that is not where they really want to be. They kind of liked where they were when interest rates were right about 7%, but then after, when everybody believed this higher for longer, things changed and interest rates rose all the way up to 8%. But the Fed reeled in their comments a little bit yesterday. They sounded a little less hawkish, so as a result, we're seeing that the 10-year Treasury and mortgage rates, long-term duration assets, are coming down. So the last time, though, that we saw interest rates at 7.5% or even 8% was all the way still back in 2000, the year 2000. And that's when Russell Crowe's Gladiator came out. Just watched it with my wife again for the first time in like decades, and you know what? It was fantastic. So really, this boils down to home affordability. So home affordability is an absolute issue when you have interest rates go from 3.25 all the way up towards 8%, and you can see this in looking at the affordability metrics. And this is actually brought to you by the Federal Reserve Bank of Atlanta, and this is the affordability monitor. You want to look at the U.S., which is not the metro areas, but the U.S. share of income at 44.6%. That's the green line. Now you can see that this is the share of monthly income that's being devoted to the monthly payment. This is getting out of bounds. People can't afford 50% of their income to go towards to exhausting the payment. And as a result, what that's done is it's just crashed the number of buyers that are available to actually purchase in this marketplace. Going from 7% to 8%, which is what we did earlier, that actually excluded 5 million Americans from being able to afford a home. So now that interest rates went from 8% down to 7.5%, it's starting to open up the door a little bit to home ownership, but still at 7.5%, there still is an absolute affordability issue. Because remember, at the beginning of last year, we were at 3.25%. So as a result of interest rates going from 3.25 all the way to where they are today, mid 7s to 8%, there's been a waterfall dive not in home values. Not in home values at all. Instead, there's been a waterfall dive in the number of closed sales, the number of transactions. And you can see it here that this is across the United States, the number of home sales. Now, this is home sales. This is a seasonally adjusted annual rate. So based upon, on a monthly basis, based upon the number of sales, they do an annual rate that's adjusted for the kind of season that we're in, which we're in a little bit of a slower season right now because we're in the fall getting towards the holidays as well. So, but what I want to point out is kind of been here before. You could see that in January of 99 all the way up to prior to the Great Recession, it was in 2006 that we got a waterfall dive in the number of sales back then. But that was accompanied by a waterfall dive in what else? In values, but not this time. We had this waterfall dive in sales back prior to the Great Recession, and then you could see over here that from 2012 all the way until the beginning of last year, we could see that the home sales were actually up. Home sales were up, and but since rates have climbed all the way from 3.25 to 8%, what's happened in the number of sales? Well, really, last year is where we saw the biggest drop in the number of sales. You can see it right here on the right-hand side. We had that big giant drop. It went up a little bit this year, and then it's come down, but it hasn't done much this year, but it remains at very, very low levels as far as sales are concerned compared to where we have been in the past. As a matter of fact, if you look at right now as to where we've been in the past, so being just under 4 million, I don't know why I put dollars, but it's 4 million total. But the United States existing home sales, you could see right here that at 4 million that we have not been below it that many times. So right now we're at a very, very low level, and this goes way back for decades. We're going back to 1999, and so there is a recession. There is a recession, and it's in housing. And it's not in terms of values, it's in terms of the number of closed sales. Ask anybody that is connected to real estate, from real estate agents, brokers, lenders, title, termite, inspection, escrow companies, even Home Depot, Lowe's, just anybody that that's tied to real estate has seen a slowdown, a material slowdown, and it's been pretty significant. And so the recession is in the number of units. And there are a lot of people that are actually getting out of the real estate business. There are people that have been terminated within companies that have had to go to other sectors if they want to continue to work. They might come into the real estate sector, but there's not a lot of job openings there. There's sectors outside of real estate where you can see better employment. Now, before we get into values, I want to bring in our sponsor. Our sponsor is, easy for me to say, is all about reverse mortgages. Reverse mortgages is an arena of lending that a lot of people don't even know even exists. And there is a specialist in reverse mortgages. He specializes in reverse mortgages. It's the Senior Financial Group, Inc., and it's your reverse mortgage expert. It's Kevin Kaltenbach. You can reach him at 949-910-0932. That's 949-910-0932. And with the reverse mortgage for purchase loan, you can help your senior homeowner sell their current residence, use the equity to buy their next primary residence in one transaction, and they'll have no monthly mortgage payment. Yes, that's right. You can actually, this is for seniors. They can sell their house, go buy another one, and have no monthly mortgage payment. So he's been around for a very long time, has been doing this part of lending for a super long time. He's been specializing in it since 2001. He's a 2023 director of Orange County Realtors. And so if you want to know about reverse mortgages, or if you have a loved one that you think might be a good candidate for this, contact Kevin Kaltenbach at Senior Financial Group, Inc., 949-910-0932. He's a friend of mine. He's absolutely superb at what he does. He was he even helped out my uncle and aunt who are in Colorado. He doesn't service that particular area, but got me a great referral of somebody that was able to put my aunt and uncle into a reverse mortgage. So thank you, Kevin, for your continued sponsorship. Now back to that recession. So we have a recession in the number of units, not in values. It's different than the Great Recession. As a matter of fact, you can see this. This is the Freddie Mac House Price Index for the United States, which there was a new release for the month of September that actually came out this week. And you can see that this is the United States. You know, I'm pointing to the right. Did the index, it did come down for a little bit, but it has since gone up and has hit new record heights. And this will kind of show you what's happened year over year. You can see that it dipped down year over year, was getting down towards where it was getting towards zero, but since then has lifted off, and year over year it is definitely up. And you can see here that this is the month over month index, and I'm pointing right now, highlighting right here, when from July through December, values actually came down each month. So this is month to month. So this is how you really track it. Looking at it year over year is one thing, but looking at it on a monthly basis will kind of tell you the velocity of what's going on right now. And you could see at the second half of last year, we had values coming down. But you have to understand that we had started last year at 3.25, so there was a shock to the system, going from 3.25 to 4 to 5 to 6, and then all the way up to 7.37% in October. So started at 3.25, went to 7.37. And it was such a giant digestion process of the entire marketplace that we actually, people wondered, is this going to continue? What's going to go on? So we had buyers that were very hesitant to purchase the second half of last year, and if they did, they wanted a bit of a deal on that, and they took their time, and that's where you saw some deterioration in home values during the second half of last year, and that's what I'm highlighting right here. But from January on, you could see what's happened since, that values have continued to go up. Now, this typically it goes up during the spring and summer and then starts to come down, which is exactly what's going on right now. And you're wondering, how in the world, in a high rate environment, how could we have values that are presently going up, even though we have these interest rates that are approaching 8%? It just absolutely doesn't compute for so many people, and that's why you have so many people typing in and searching on Google like crazy for housing crash, and watching on YouTube all the housing crash narrative people that are doing plenty of doing everybody a disservice, by the way, but they are pushing out that narrative, and they've been doing it for years, that there's a crash that's imminent, and they've been right. The only crash that's occurred is in closed sales, though, not in terms of home values. And and they'll find exceptions across the United States. They'll continue to throw out Austin like that's going to be that's the canary in the coal mine, which it's not. So what's really going on here? And my friend Yanni explained it. Yes, he is from Greece, and he's staying with us right now. So much fun to have this family with us. But this is our total inventory prior to or during the Great Recession, and actually started in 2006. I'm pointing to that Himalaya. That Himalaya shows how many units? 4 million. 4 million units across the United States were available. That was the available listing inventory. We had a year's worth of listing inventory actually that were available at any given point in time. So it was just a stretch to think that this market wouldn't implode. We had a glut of homes that were available. When you have way too much of something and you have few buyers that are out there, what happens to prices? They cave. Across the United States, we were looking at market times that were over a year. That's right, it was over a year to sell houses. That's what they were looking at. Place your home on the market. When are you going to close, open up, become a pending sale? It was a year. So I'm trying to get that across. That's right, 1 year. So that's a long time compared to what we're dealing with right now today. We have a little over 1 million homes. It rose all the way up to 1.3 million because it has not hit a peak across the United States. And this is also from the NAR. But you can see we went from 4 million all the way down to where that orange dotted line is. And you could see how few, even though we're at 1.3 million, there's just not enough homes on the market. And that is what we call scarcity, and scarcity in a product. When you don't have a lot of a product, and even if there are a few buyers in the marketplace, when you don't have that many, those few buyers are going to argue over this product when they bump into each other. And that's what's happening in the entry level of almost all markets across the United States and continues today. And everybody knows what that price range is within their marketplace. That marketplace is nuts. It's absolutely crazy. And that's because of the scarcity of products, especially in the entry level arena. And he mentioned it. Yanni talked about supply and demand. And it's a little bit more than just supply and demand. We have to throw at this. Sky high mortgage rates actually has changed the way supply and demand works. Because last year, even though we had a limited supply, we still had values come down because we had interest rates that were 3.25% and made their way all the way up to over 7% the same year. And it was such a shock to the system that there was an issue, and that was this affordability crisis versus the supply scarcity. And it's been a tug of war. This year, we had interest rates that came down a little bit from above 7% in October, November of 2022, and during this year we had a supply scarcity that grew to, at the beginning of the year, very few homes on the market, and affordability crisis wasn't as big of a crisis because we had interest rates come down a little bit, so people were starting to get used to it. But you know what? Since the springtime, we've actually had the supply scarcity shrunk a little bit because we've had the inventory rise, and February 2nd we had interest rates at 6%, and since then they've come all the way up to 8%, so the affordability crisis grew. Now you have this push and pull where the affordability crisis is pulling one way and the supply scarcity is pulling another, and it's almost like at an equilibrium, like a balanced market. It depends upon the market, it depends upon the price range too, and everybody knows where that is within their areas, because yes, there is some pushback on prices in some areas, and there are others where there's still a real big supply scarcity issue, and yet so we have values that are continuing to go up. And I showed that. I've shown you through September on the home price index that it continues to be elevated on a month-to-month basis. It continues to rise. That should dissipate for the rest of the year until we get to the start of next year, and then we'll watch that thing rise again unless something drastic happens in rates again, or if something happens to scarcity of homes, which always happens right now. The fewest number of homes come on the market in December, second fewest in November, and as a result, and a lot of people pull their homes off the market, sellers do, to take advantage of enjoying the holidays. So as a result, we'll watch inventory really come down. And so we have not hit a peak across the United States in the available inventory, and it's going to happen within the next couple of weeks. This is courtesy of Housing Wire's Altos research. And across the United States, it's a little bit below 2022. I look at the Bay Area and Southern California. It's actually far below 2022. But you gotta also know your market. Collectively, a little bit below 2022, and then it's about to peak at any moment within the next couple of weeks, and then it's going to come down, like I said, for the rest of the year, and it'll be off to the races. So you'll have to continue to watch us to find out exactly where inventory is at, exactly where rates are at, so you can understand the marketplace. Because right now, it's a little bit more balanced. We're not going to get a lot of juice in home prices going up, but we're not going to get a lot of juice in home prices going down. But in many markets, collectively, probably we'll see a little bit of values come down for the rest of the year, a tiny bit. But then, like I said, it'll be a totally different story when it comes to spring. So. You know what? If you would like to subscribe to the Housing Report, you can go to, we have lots of them all over Southern California and in the Bay Area, and we're about to launch another market at the end of this month. And you go to reportsonhousing.com. The most recent one that came out is called Is the Price Right? Now, San Bernardino, Riverside, and the Bay Area will get this next week. It's called Is the Price Right? And what I'm talking about in this, or what we're talking about, is if you have to reduce the asking price because you come out and I just want to test the market, you will net less. You will get fewer dollars in your pockets if you don't spend a lot of time pricing it right from the get-go. You'll be on the market for longer and you will net less, and I'll show you statistically with data how that happens. And if you'd like a free month, utilize the coupon code SALES. Go to reportsonhousing.com, use sales, because we were talking about sales today. And if you do that, you'll get that free month. And the most recent podcast launched Wednesday of this week, and it's called Haunted Housing. Anywhere you want to go to listen to podcasts, go listen to it. Look at Reports on Housing, and it's called Let's Talk Housing. And go ahead and, you know what, take a listen. So thank you again for joining us. I really appreciate it. To another Housing Debrief. This is done. Let's put it in a can. Like and subscribe if you liked it. And if you'd like to subscribe for more. And have a great finish to your week. And we will see you on the